I'm sure that at some point in our lives, every single one of us has probably heard the phrase, oh, you should invest into Bitcoin, you should invest into silver, or you should invest into the stock market. And the hardest part is actually figuring out what to invest in. What will give us the biggest return on our investment and keep us from losing all of our hard-earned money. I'll let you in on a little secret. Nobody knows what the stock market is gonna do.
Okay, if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is gonna go up, down, sideways, or in circles.
All we know is what it did in the past. But what if I told you there's an investment strategy that is so simple and so easy to use that the hardest part of the entire strategy is figuring out what brokerage account to use or what investment account to use? This strategy comes from one of the investing greats, John Bogle. He actually wrote a book called The Little Book of Common Sense Investing. He's the founder of the Vanguard Group, one of the biggest investment groups in the world. He also created something called index fund investing, which allows investors to buy mutual funds that track individual indexes like the S&P 500 or the Dow Jones. And one of the theories that he believed in is hitting the like and subscribe button, because that actually doubles your investment within the first year. He actually believed in something called the efficient market hypothesis, which states that the markets are so efficient, it's almost impossible to consistently beat the market year to year. Sure, you can get lucky and invest into GME when it was at $3 and then sell it again when it was at $340. But the real question we have to ask ourselves is, can you actually do that on a year-to-year basis? Not just 1 year, but 2, 3, 4, up to 10 years. And on that note, let's look at some statistics. 89% of professional fund managers failed to beat the broad market over a 10-year period. And I'm not talking about just the everyday investor. I'm talking about investment professionals with their fancy degrees and them working on Wall Street. If they can't beat the market, then how do we, the retail investors, even hope to come close to achieving that dream? And if you can't beat them, why not just join them? John Bogle actually created a whole cult-like following, which call themselves Bogle Heads. They believe that a 3-fund portfolio is more than enough to get the best returns out of the market. The first portion of that entire portfolio should be a broad market index fund like VTI or the S&P 500. The second one should be a broad market international fund, and the third should be a broad market bond market fund. And if you stay towards the end of this video, I'll put together 2 mock portfolios so we can get a prime example of what these portfolios would look like. So if you're interested in setting up a portfolio like this, the first question you have to ask yourself is to ETF or not to ETF, which means, would you like to pick 3 different ETFs for your portfolio, or would you like to go with the tried and true method of low cost index fund investing? Asking me which strategy would be the best for you is like you asking me what kind of car you should buy. Well, if you live out in the country and you like to haul big things around, I recommend for you to get a truck. But if you have a family of 10, obviously you need something like a minivan to get around. The same goes for the ETF versus index fund debate. If you like having the ability to balance your portfolio at any time, meaning you just take whatever shares you have and you can sell them that minute, I'd recommend for you to get into an ETF, because those trade whenever the market is open. If you decide to go with index fund investing, you can only buy and sell those at the end of the market trading day. The next big question you have to ask yourself is, how much money do I have to actually get started with investing? The key takeaway here is that with any kind of ETF, you're tied down to the exact market price of that current ETF. If we take VTI, for example, at the moment, it's currently trading at around $258. So if you wanted to invest into that stock, you'd have to buy the whole share of $258. But if you wanted to invest your money into an index fund that's similar to VTI, something like SWTSX, the minimum investment on that is only $1. So you don't have to buy the entire share, you can buy a small portion of it. So if you're not Mr. or Mrs. Moneybags and you're nothing like Donald Trump,
you know, I started off in Brooklyn. My father gave me a small loan of $1 million.
The index fund strategy would probably be the best for you. Now, like I said earlier, let's get into building some theoretical portfolios. First, we'll start with the ETF portfolio. Let's pretend that we're 25 years old, so we have a very, very broad horizon in front of us for investing. Now, let's say we have about $1,000 just to get started with investing. Let's drop the first 50% or $500 of our portfolio into VTI, which is a US broad market fund. That means we'd be able to buy about 2 stocks for $258 a piece. That would leave us with about $416 left to invest. Now we need to take care of the international portion of our portfolio, and I would recommend VXUS, which is an ETF for international stocks that are not already included in VTI. Buying 4 shares of VXUS would probably set us back around $244, and we're left with about $172 to drop into BND, which is a broad market bond ETF. And at the end, we're left with about $30, which we can't really invest into anything else because with an ETF, almost always you have to buy the entire share. Now let's move on and build a similar portfolio using index funds. Let's substitute VTI with SWTSX, and let's drop about $600 so it'll make up the bulk of our portfolio. Next would be SWISX, which we would substitute for VXUS, and we drop about $300 on there, or 30% of our portfolio. And that would leave us with about $100 to spend on SWAGX, which is a bond market index fund. So our portfolio ends up being 60% US stocks and 30% international stocks, leaving the last 10% in bonds, because the theoretical person we chose to create the portfolio for is only 25 years old, meaning they have a very, very broad horizon in front of them for investing, and they're very, very risk tolerable. They're not afraid of losing a little bit of money in the short term to gain a lot in the long term. And it doesn't really matter what you choose, the ETF route or the index investing route. The important thing is to choose to start investing as early as possible. The more money you have invested in working for you, the less time you have to spend working for your money. But the one question you might have left over after watching this video is, what investment account should I use to implement this investing strategy? So go ahead and click on this video next to figure out what investment account would be the best for your situation.